welcome everybody. Thanks for joining us here today. Here's our options disclaimer. Options are a complex derivative product that involve risks and are not suitable for everyone. It's important to have a full, complete understanding of the product before using them in a live account. And a little bit about OIC. We provide free education to the public on equity options. We discuss the benefits and risks of the listed product. Optionseducation.org is where the bulk of our education is. You can review strategies, podcasts, videos, and archived webinars, and also take advantage of the investor services team at options@theocc.com. You can email them any options-related question you have or questions about our website, and they'll be glad to help you out. As for today's webinar, the last thing to mention is please take our survey. We review every piece of feedback we get, all your comments, suggestions for future topics, what you thought worked well and what you thought didn't work well with today's presentation. We look at everything and it helps us shape the program moving forward. Today we're going to discuss selling options. From a more general perspective, we'll try and touch on as many pieces of selling options as we can. The second quarter of 2019 has been centered on selling options, and we've gone through some critical concepts and we've gone through some strategies. We're going to have our simulcast event in June 29th to cover some complex strategies. Today, we're going to keep it more broad and have a discussion. I'm very pleased to have Jamal Chandler join me today, who's an instructor from SIBO Options Institute, to share his insights into not just selling options, but some market analytics and how he views trading options from the selling perspective. So Jamal, thank you very much for joining me here today. And why don't you start out by telling our audience a little bit about your background and the good things you're up to with SIBO today.
Well, thanks, Ed. I appreciate that. Thanks for having me today. As you said, I am an instructor at the SIBO Options Institute, which has been around for over 35 years and helping with investor education. And I basically came into this industry almost 15 years ago, and a lot of what I learned came from working at a proprietary trading firm. And for those who are not familiar with that type of setup, it's essentially a setup where you have a firm that has partners and they have their own money in the firm. And in our case, they teach you how to trade. And so I learned a lot about options trading, options volatility, and portfolio style trading from working there. And then also picked up a lot of other things along the way, seeing how markets intersect when you're talking about commodity markets and options markets and bond markets and currency markets are all kind of, interconnected in some way. But obviously options was the biggest thing, and we traded a lot of options on a daily basis, mostly in a portfolio style type of way, stock and options together, sometimes directionally, whether it was directionally with just, the side of options, whether long call, long put, or et cetera, or sometimes vol trading. So that's where I learned a lot of my craft, and hopefully I'm always willing to try and share some of that knowledge.
Well, that's a terrific background, and we certainly appreciate you being here to share your expertise on the topic for today. Jamal, let's start with this. Of course, when you trade options, there always has to be a first step, a market outlook or an objective. And of course, you can either buy options or sell them. So let's just discuss a little bit the difference between the two, maybe first from the buyer side and then from the seller side. How would you describe the differences in the market outlook and the motivations between buyers and then from the seller perspective?
Yeah, that's a good question, and it really depends on a lot of different scenarios, So say, in general, like you said, the bigger two things pertain to market direction, currently where the market is going, and sometimes where you feel the market is going to go, and implied volatility, which is a huge key component of option pricing. And so, for buyers, a lot of the time they're looking for, to take advantage of a direction that they feel a stock or maybe even the general market, if they're trading index option or something, what general direction they feel the market is going to go in. So if the market is typically kind of going up, you'll see people who will look to take advantage. Say you have no position on, you'll look to take advantage of that by buying a call. However, you can also, if you have long stock already, you may look to take advantage of the market going up and sort of, sell a call, right? Like you could sell an upside call against your long stock and have that covered call position and let the market eventually, take you out of that position. I think we'll get into the idea of covered calls and how you look to sell those later. But you could look in that way. Or the same thing with put buyers. When the market is going down, people are typically trying to look to take advantage of that by buying puts. Or they could have protective puts against their long stock, right? Because then you can protect some of your gains that you have with your long stocks already. There are people in individual situations where you have, just say the market is doing fine, but say an individual stock is going down and it's a stock that you like, then maybe you look to do to sell a put against that and have a cash secured put, in that you will sell a put at a position where you would be comfortable buying stock. So I think there's several different ways to look at it, but people are often trying to find ways to capitalize on what the market is giving them. And when you incorporate implied volatility into that, and well, now you have to account for how is volatility going to affect my option, and in what way is that going to take place. So if you're buying options, you want that volatility. You want volatility to increase because that helps the pricing of your option. Vice versa, if you're selling options, you want volatility to be calm and sort of come in. So it really does depend on the type of market in which you choose to do these things.
Yeah, that's a great way to describe it. Generally, as you said, buying options, the investor wants the market to move somewhere in the direction of their option. Whether it's a call, they want the market to move up, and if it's a put, they want it to move down. So buyers are looking for that move, and sellers are trying to capitalize, you could say, on the lack thereof of that move. But you put it well. If you do have a combination of stock or other options in the mix, that could make things more complicated. But that's a good layout between buyers and sellers. And let's sort of stick with that pre-trade theme. Before you get into the trade, there has to be some form of maybe technical or fundamental analysis, or some way to gauge the market so you can decide for yourself, am I bullish, bearish, or neutral? And then you can try to put your trade together from there. So from your perspective, Jamal, what do you like to use as far as your analytics, technicals, fundamentals, maybe a combination of both, or maybe something else? How do you use, or what tools or what analytics do you use to fine-tune your opinion on the market?
So the interesting thing about that is that when I first started in the business, right before I came in, I was trading stocks on my own. That was kind of my introduction into the business, and before I worked anywhere. And I did a lot of what I learned just happened to come from, and this is no plug, I don't work for them, but I ultimately learned a lot from Investors Business Daily. They do a great job of laying out a lot of things as far as technicals. And then some stuff that I did just kind of encountered on my own through reading different, various books or papers, what have you. But technical analysis was definitely something that I was really interested in. I thought that it could kind of give you interesting little tells from time to time. And my personal opinion is that a lot of times with technical analysis, it kind of shows you the greed and fear that are in the market, which I feel are two large driving forces in the market. And so that was kind of my base understanding. And in the beginning, when I first started trading options, I had the darndest time trying to get the two to coexist. I really couldn't figure it out exactly, especially learning how to trade volatility at the same time, and then trying to figure out which, kind of a directional play I want to make on something that I feel, say had a cup with handle pattern, and how was I going to take advantage of that. But eventually I helped, I kind of learned how to put it together. But the other thing too that I would say trading is similar to my favorite sport, basketball, and that you have to take what it gives you. You have to take what the market gives you. They say in basketball, you have to take what the defense gives you. You have to take what the market gives you. And so you try, going back to like that market direction, implied volatility, you try to take what the market is giving you in that way. And so technical analysis is one of those tools you can have in your tool bag to look at, different chart patterns and try to assess the best way to go about that. But I do feel it's important to have both, because there are times where I will use fundamental analysis to drill down, say, between two similar companies and trying to figure out, maybe if I'm buying stocks, for example, which one do I want to work with best? And then I may find that company, and then I may get long stock in that, and then may, find a situation where I may want to sell an upside call against that and get a covered call. So I think it's important to have both in your tool bag.
Yeah, I think you said it really well there. Take what the market gives you. Of course, you can't force profits onto the market. You have to analyze the market and take what it gives you, and sometimes manage risk appropriately. Your answer is fantastic, and it's similar to what I hear from many investors out there who say, I like to use both to a certain extent. Technicals and fundamentals can be both important. One of them can help you decide where your favorite strategies might be and what direction you might want to lean yourself with your trade, and the other can help fine-tune that opinion and drill it down into a specific trade. So a combination of fundamentals and technicals is certainly a popular theme, as you touched on. You mentioned implied volatility. For our listeners, are there any specific tools or online metrics that you use in order to find those implied vol levels? Are there any favorites that you have that you use to discover these market metrics?
For me, these days I look at one of our in-house tools. SIBO has a live vol tool that we typically look at day in and day out. It provides you a lot of information about volatility across all stocks, about as it relates to earnings, but it also just kind of gives you a chance to look at different vol charts. And I think most brokerages have some type of thing that allows you to analyze volatility or look at vol, because implied volatility is key in the pricing of an option. When you're looking at an option value, you'll have that, intrinsic value of an option, which is just the difference between the strike in the stock, and then also that extrinsic value, which kind of gives you the idea of the volatility value that is within that option. So it is key if you can find a way, those who are listening, find a way to at least be aware of the volatility value of your option. And typically most brokerages have one, but for me, I look at SIBO's live vol because that's kind of what we have in-house, and it's nice.
Yeah, it certainly makes a lot of sense, and you're right. I think from my experience, a lot of brokerage firms have these kind of Greeks at their disposal, so check with your firms, and OIC has it as well on our Options Quotes page at the optionseducation.org website. You can find 20-minute delayed quotes that also include the Greeks next to the options. I'm going to come back to vol. You mentioned vol a few times. Let's get back to vol in a second, but first I do want to talk a bit about Theta. It's so important to be aware of Theta and what it is, and maybe some deeper details about Theta. Since you're selling options, you're trying to capture the lack of movement in the market and capture extrinsic value and time decay. So let's walk through Theta a little bit, Jamal, a definition of what it is, and then we can get a little bit deeper about what you see on the screen. What does that number mean, and when does Theta start to accelerate? So what can you tell us sort of start to finish about Theta?
Yeah, you're right, Ed. I mean, it's an important thing when it comes to options, because it lets you know the options value, the option value sensitivity to time. And the one thing that we all know, almost like death and taxes, is that options expire, and you need to be aware of the time frame that you're trading. You need to be aware of how much your option, in the sense, is, if you're long it, how much it's costing you. And so it's that Theta is that time value, but with respect to options. But I know one of the ways that I eventually learned to look at it when I was trading, we used to talk about it all the time, it is basically how much you're paying or collecting on an option per night. So if you're long options, you're paying Theta, and if you're short options, you're collecting Theta. And you'll see it represented in those ways when you have the calls and puts. If you're long call or put, Theta will have a negative amount. And if you're short call or put, it has a positive amount. So it's with respect to the option. Doesn't matter, whether it's call or put. It's just respect to that. In an option, if you're long them, you're paying Theta. If you're short them, you're collecting Theta. And so that's the most important thing to understand. It's another, thing to know about your option. However you're trading, however you have a position, you need to know, okay, if I'm long options, my option every day, it's not going to be in the money. It's going to decay some. It's losing some of its value to some degree. So I think that's the best way to think about it and look at it.
Yeah, and you're right. The options themselves have this negative Theta component, but of course, as you said, if you're buying options, that's working against you, and your position would have negative Theta. But if you're selling options, it's actually working in your favor, and that would be considered a positive theta position. As far as the numbers concerned, I just want to say that the number you see on your screen represents the amount of premium that's expected to come out of the option from the passage of one day, and that's a calendar day. I just want to caution investors. Sometimes investors will say, well, couldn't I just sell options on Friday afternoon and get this quick 3 days of calendar days come Monday morning? And of course, it doesn't work that easy. The market doesn't give away anything for free. I remember way back my days on the trading floor. I mean, we're going a little ways back here to being on the trading floor, but every single Friday before a weekend, especially a holiday weekend, one of the questions that we asked as a trading team was, when do we start to take out the weekend? And that was a term we used. When do we take out the weekend? And on Friday morning, sometimes on a slow day, we would manually reduce the number of days till expiration to start to reflect Monday morning prices, so we could see what do we expect these options to be worth come Monday's days to expiration rather than Friday, and that helps you forecast that weekend, especially, like I said, if it's a 3-day weekend, you have 4 calendar days coming out. So it's not as easy as just going in and selling on Thursday afternoon or on Friday and capturing quick theta decay. Traders are a little smarter than that, and they don't let you get away with it. Let's shift a little bit to the rate of decay, and this is something that's debated quite a bit about when this accelerates exactly and when's the best time to sell and how to manage that. So Jamal, what do you think about sort of that long-term decay, and then as it starts to accelerate, when that is, and how should option sellers be thinking about this curve of decay as they're considering when to pick their expiration dates and then manage their positions?
So for option sellers, a lot of the times, people, and I think the one thing to start with in general is that those who are learning to trade or getting, hopefully eventually you'll find an area of, I find a time frame that kind of fits your trading style. I think that's a good thing to try and learn, because some people are really good with trading, near-term options. Some people enjoy a longer-term out view and look. So with that being said, it is important to understand that with respect to Theta, we talked about the fact that options are going to expire at some point. They do decay in value, and you have to understand that as you get closer to expiration, all of that magnifies, it accelerates. And so the idea of your option decaying and over time, decaying as in like that value of the option coming out within each day's time, that accelerates as you get closer to expiration. And so that is something to, and it's even more pronounced in the out of the money options as opposed to like at the money. So it's something to be aware of as your value. When you're looking to sell options, you need to, sort of try and figure out, okay, if I'm selling an out of the money option that I hope is not going to become in the money and I just get to keep that premium, that's kind of how people will typically look at it. So understanding that, say with 10 days to go, I'm looking to sell some options and I'm looking to sell something that hopefully doesn't, come into the money, and then I can just continue to collect that premium as time is accelerating towards expiration. That's something that people will usually look to do if they're option sellers.
Yeah, I think you said it well. I'm gonna quote you again. Fit your style. It reminds me of something I read about just a few days ago about how trying to trade someone else's style doesn't work, and that's why trying to listen to advice or having someone you think is smart that makes money in the market tell you what to do often doesn't work, because everyone has their own style and their own preferences. So options trading is no different than that. As you're analyzing the market, you have a different time frame and a different management technique and style than everybody else. Some investors are comfortable selling options 6-7 weeks out and then managing them with 2 or 3 weeks out. Some others like to sell options on a weekly basis. Weekly options now account for, I think, about 30% of all volume. They're very, very popular and popular amongst sellers. Buyers want the leverage for a cheap premium amount. Sellers want the quick decay. So there's a different way to answer that question. And as you look at this or think about this curve of decay, at the money options start to increase their deceleration in premium around that 6-week time frame, but that's not necessarily the best time to sell an option. You have to fit your style, as you said, Jamal, and fit it into your market outlook as well as you manage it. Now, you've mentioned IVOL, implied volatility, a couple of times, so a few things come to mind there. For the beginners who are listening, can you just walk through how does implied vol affect option prices, or when is it going to be more significant? And just in general, what should we expect to see as far as option premium amounts as implied vol changes up or down?
Sure, yeah, you're right, Ed. I've mentioned a couple of times it probably would help for those who may not be familiar if I kind of explain a little bit. But implied volatility just represents that current market price for volatility. So it's that theoretical measure of how a stock might move over time. So volatility in general just measures the swings in stock prices. And implied volatility typically will be based on the current market price of those options, what's currently happening. And that could be priced based off of maybe an event or, earnings or something like that. So it just really depends. And, that being, I think along with that, we get back to what we talked about earlier. That being said, there's two components of the value of an option. There's the intrinsic value of the option, which is the amount by which it's in the money. And there's that extrinsic value, which is the time value, or better known as the volatility value of that option. And so within that, that's where implied volatility comes into play. That kind of determines a good portion of how much value your option has. So, for example, if you have an out of the money option, well, that is considered to be all time value, all volatility value. That's the only thing that's giving that option value. So it's good to be aware of that kind of thing. And again, when we're talking about volatility. Volatility is based off of different, drivers in the market that determine volatility. So if you have an option that has earnings, well, that's going to have a little more volatility value to it because it's capturing earnings and it's expecting an event, and that event could swing the stock in a couple of different ways. So that will affect the volatility value of your option or the implied volatility. And typically, if some of you haven't noticed this yet, with trading, when you have an option that is catching earnings and earnings are about to happen, implied volatility will typically rise into that event because of the uncertainty surrounding that event. So it's important to understand how implied volatility can affect the pricing of your option, whether it captures earnings or whether it doesn't. You should be aware of that.
Yeah, for sure. And I'm gonna continue with that thought that you just mentioned there, because one of the things that I frequently get asked about when I'm on the road talking to investors is, the concept of implied volatility. You said very important. It affects option prices in both directions. When implied vol rises, then the range of possible stock prices also rises, or it gets wider, and that increases all option prices. And then the opposite is true. When implied vol comes down, then the expected range of stock prices shrinks, and that would lower all option premiums. What that leads to is the possibility that an investor has chosen the right market direction. You mentioned earnings, and this is when it usually comes up. That an investor has picked the right direction, but they actually lose. And that's one of the moments when I get the most frustration from some options investors. I was bullish, and I put on a bullish trade, and I lost. And then you have to move to this implied vol. So can you just talk about that a little bit and elaborate on that earnings and how you can lose having the right direction? And it's because of implied volatility and those moves that some investors don't really forecast when they're trading options. Can you just elaborate a little bit there, and maybe specifically with the earnings example?
Yeah, Ed, that was something that was really frustrating to myself when I first started trading. A lot of times they would have us, whatever position you may have, whether it was just an outright long option and directional, or whether it was, option with stocks, so, kind of combining that and creating a volatility type position, we would have to determine, and I think this is a good practice for a lot of people, whether they do this with their actual trade or whether they do it with a paper trade. It's always good to try and figure out how you make and or lose money. So if you have, let's say you have XYZ stock, and currently the stock is trading $50, and you believe it's going to go up, and so say you have a 55 call that you're long, that you paid money for. So say you paid $2 for it or something. Let's just add a value to it, and say it does have earnings. So obviously, not only is it out of the money, that $2 is all time value or volatility value. And so say after the earnings come out, say there's 2 days to go and the earnings come out, 2 days to go until expiration, excuse me. And then say earnings comes out and after earnings, the stock did well, everything's fine, but the stock goes up $2, so now it's trading $52. And again, you're long the 55 call. After earnings, the volatility almost always comes in, or the volatility comes back to where it normally may be. Every stock has what's considered a kind of fair volatility. That's a volatility that it usually operates on because most stocks typically move. And this is a generalization. Most stocks sort of have a typical type of movement in the way that they trade. And so back to our example, if the stock is now trading 52 after earnings and you have the 55 call that was worth $2, chances are it's not going to be worth $2 because there's about 2 days to go until expiration and the volatility has come in quite a bit. And so now your call may be worth $1. You might have lost a whole dollar of volatility value, and now you only have $1 on that 55 call is worth. And that's a perfect example of the volatility kind of being sucked out of that option. It's out of the money, and you have only not much time to go until expiration. And if the stock ends up trading 52 at expiration with when it's finally getting on expiration date, well then that 55 call is going to expire worthless. So that's an example of how you can have the direction right. It did go up, but it didn't go up as much as you would have liked it. Because again, you have to remember, if you're long that 55 call and you pay $2 for it, well, your break even is 57. So not only are you quite a ways from the strike, but you're also quite a ways from your break even. So that's an example of how you can lose money even though you were right in the direction that you were going. So I guess one of the ways to sort of prepare yourself for that is have an idea of the I would say the typical volatility that a stock may move on. And again, this goes to looking at a volatility chart, but and this may be a little bit advanced, but have an idea of when an option may be quote unquote overpriced and when it's not because of an event that's going to happen. And that's one of the risks of playing earnings. I mean, earnings are great because they give you a great chance to play a binary event and maybe make a lot of money, but there also is that possibility of something not coming to fruition as well. Hopefully that makes sense. I wasn't a little too long-winded on that, but I think it's an important thing to understand.
For sure, yeah, you said it really well, and for those investors out there who have found themselves in that situation, it's understandable. If you're long a call option and the stock moves 2 or 3% higher, and you check the quotes and you've lost money, that can certainly be frustrating. And if you don't quite have a grasp on implied volatility, then that can catch you off guard. You mentioned one key thing there that reminds me, again, going back to the trading floor. One thing, when you're a professional, you're trading the same stocks. You're trading the same options on the same stocks every single day, and you have a very intimate knowledge of how those options trade and what the implied volatility levels should be and how they move after events like earnings announcements. So professionals can get a gauge for where they might expect prices to be after the earnings announcement. One thing investors can do, you're not totally lost. You can use an options calculator like the one we have on our website, one of the tools we have at optionseducation.org, and forecast what you think future levels of implied volatility might be and put in the rest of the relevant info, the stock price, the strike price, the days to expiration, and calculate what a theoretical value for the option might be under various levels of implied volatility. That can give you an idea if the stock just moves up a couple of dollars, but implied vol gets crushed by 10, 15, or 20%, what does that do to the option price? You can start to forecast and learn what that might be so that doesn't surprise you in the future. But that was really well said. So we've covered some Greeks, Theta, some implied vol. Yes?
Oh, no, I was just saying thanks. Yeah, I mean, you're right, and I think you did a great job as well. It's a tough thing to understand, but I think the exercise of trying that when you have it, whether you map out a position or you do it with a fake money type of account, or whether you do it for real, it's good to understand how you are making and losing money. I think that's really key.
Right. Yeah, and before we move on, I want to maybe sprinkle in a few questions from the audience, and we'll take some more at the end. Question did come through here, Jamal. Is there a certain theta number or range that is better for sellers of puts interested in only collecting premium? I believe that question is either centered around theta as a number or maybe a time frame. But just as far as looking at theta and knowing days to expiration, if you're only interested in collecting premium, you're not interested in maybe using cash secured puts to buy stock or using short options to hedge something else. If you just want the premium, is there a rule of thumb you like to follow, or as you said, is it sort of fit your style to each his own? Each situation is different. How would you answer that question?
So the way that I'm hearing this, at first I want to make sure people understand when you're talking about a theta number, the way that your theta number will be determined, let's say all things being equal and you're looking at 1 month out option, right? And so the way that your theta number will be determined is the amount of the amount of options that you sell, and it also depends on the stock, for example. So if you're trading like a higher dollar stock, and again, we're talking about across the board 2 months out, or 1 month out, excuse me. If you're trading a higher value stock, that theta is going to be a little bit bigger than a smaller value stock. But it also depends on the size of the amount of options you're trading. If you're trading a 100 lot versus a 10 lot. So I don't necessarily know I'd focus on a theta number versus just the amount of premium you may want to collect. I think that's probably the better way to go into the trade. You have an idea of the amount of premium you want to collect. Also, the strike that you're choosing. I think strike selection is a big part of it. If you're, in this case, you were talking about selling puts. If you're selling puts, you want to sell puts at a strike where you potentially could be comfortable owning the stock, because that's eventually what would happen if you get assigned on those puts. You're going to be owning stock at that strike. And so it's important to be comfortable where you sell, and I think that's where strike selection is important. But again, you have to be aware of the type of premium that you're selling. I mean, you could go out there and sell penny premiums all day, but that's just not something that most of us will recommend you do. You should try and find the amount of premium that you're comfortable doing, and also the strike where, in this case, we're talking about selling puts, you'd be comfortable owning the stock.
Yeah, certainly agreed with that. Rather than focusing on the actual theta number, it might be beneficial to look at the total amount of premium you're receiving, and specifically that's the time value component. For out-of-the-money options, that's the entire premium. If you're doing something in the money, then you want to isolate the extrinsic value. So the total amount of premium that you're selling and the time to expiration. Be aware of where you are on that curve, whether that's the 6 weeks out or the weekly out. Just be aware of where you're at and focus on those total premium amounts rather than the one numeric theta number. So nice job with that. Let's move. We've talked about some Greeks, when to sell options, what kind of motivations you have, technicals, fundamentals. We've touched on theta and implied vol. Now some of the things that are just critical for investors to understand who are on the short side, and that's really the assignment process, and then we'll get into pin risk after that. But before I ask you about assignment, let me just describe exercise. First of all, exercising options is something only holders of options can do. If you're short an option, you can't request to be assigned. You can't do anything to expedite the process or increase your chances of being assigned. It's a random process. Only buyers can exercise, and they do so one of two ways, either by notifying their brokerage firm of their intent to exercise, or if they don't do that, at expiration, if they haven't contacted their brokerage firm and the option is in the money, then the brokerage firm will likely auto-exercise that option on their behalf. And that's the exercise part of it. Now, since we're focusing on sellers and being short options, Jamal, can you just walk through a little bit of that communication and how things work? Of course, when you're a seller and you're short an option, if you're an option writer, you're not communicating to your brokerage firm. So what should investors know about when they're going to be assigned and how they'll be informed of that?
Well, like you said, at that point, if you're a seller, then you will get assigned on your option. And I think so you typically will get a notification from your brokerage. I think sometimes brokerages will maybe notify you the day before if it's close in those situations. And again, like you said, with automatic exercise happens with a penny in the money. When you're getting assigned, you have that obligation to buy or sell stock depending on whether you have put or call. And I think one of the big things to know is that you should have, it's important to have enough money in your brokerage account to cover any potential stock position that's going to be created from assignment. That's probably the most important thing. You want to be able to have that so you don't have to deal with any issues with regard to a margin call or anything like that. So, but you will typically get an exercise notice from your brokerage. They'll give you a heads up as to like, hey, this option is closed. You might be potentially assigned on it going into the next trading day. So that's typically helpful. But again, having the amount in your the amount of funds in your portfolio that will help you go through that assignment process is key.
Yeah, each firm could be a little different in how they communicate that. So if you are trading options or you're about to, it's certainly important to know how and when they're going to notify you of assignment. And myself, having been with OCC for quite a while, I'm quite familiar with that process behind the scenes, and it's insightful to walk through that. As I said, the exercise process starts with the investor, and they communicate to their brokerage firm, who in turn turns in an exercise notice to OCC. Well, assignment works the opposite way. It starts with random assignment at the OCC level, who notifies a clearing member firm, who notifies their brokerage firms of assignment. And these are SEC-approved random assignment methods, first of all conducted by OCC to assign a clearing member firm that has an open assignable position. The individual investor could have an account with either one of these. Some listeners out there will have accounts with clearing member firms. Others will have accounts with a brokerage firm that uses a clearing member. Either way, that line of communication goes in the other direction. Starts with OCC, goes to the firms, and then gets to the investors and the traders. And I have to state this, whenever we talk about assignment and exercise, keep in mind, this goes back to maybe some people newer to options, an option does not have to be in the money to be assigned to you. And if you're short a call option or a put option and you're watching it to the closing bell on expiration day, and it looks like the last trade in the stock was a few pennies out of the money, so you think you're safe, that's really not the case. The option holder can exercise for whatever reason they choose to do so. They can watch aftermarket, after-hours activity. They can watch the news headlines after the closing bell on an expiration Friday, or for whatever other reason they want. If they decide they want to exercise, they can do so, even for out-of-the-money options. So if you're short and the stock is close, there's some level of uncertainty that you're going to have about whether or not you'll be assigned. And of course, there's another very important topic with the exercise and assignment process. It's pretty clear cut when you get to expiration day. There's no time value left. Everything is all about in or out of the money status, or if the holder decides to contra exercise and exercise an out of the money option, that's fairly easy to understand. Let's spend some time on what might be a little more difficult to grasp, and that's the early exercise component. So if you're short a call option, what circumstance, Jamal, would lead to possible assignment, or when should a call writer start to be concerned or think that they might get assigned early?
So typically in those situations, if you're short a call, and as one of the big drivers of getting assigned on a short call is when the stock pays a dividend. So if the call ends up being in the money and the time value of the amount of the call, the time value of the amount of the call's market value is less than that dividend amount, then you could potentially be assigned on that call. Somebody will exercise their call option as just before the dividend pays, so on the ex-dividend date, and you will get assigned on that call, and that will obligate you to sell shares. So that's typically one of the ways that it happens, because with equity options, people have, they're American-style options, and so you can exercise at any time prior to expiration. So one of the things to sort of put yourself in a good position and be aware of, does that option or does that stock, for example, pay a dividend? And what's the size of a dividend? A lot of the times you can be on top of that situation. That's something that we learned when I was trading, this idea of attention to detail, knowing that if the stock that you're trading options in, does it pay a dividend? What's the size of the dividend? Does the dividend get paid out in the month that I have options in? If I'm short calls, then that's something you need to be aware of, because there's a good chance you could get assigned, and like I said, you could be obligated to sell stock. So that's one of the best ways to sort of look ahead and understand, okay, is this something that I'm going to have to pay attention to, because it is important.
Yeah, knowing if the stock you're trading options on pays a dividend, and then being aware of those ex-dividend dates, certainly very important. Something for maybe listeners who may be more on the advanced side, of course, there's options pricing formulas. I mentioned those briefly earlier that can calculate theoretical values. Generally speaking, dividend payments lower the forward value of a stock. So at some point, these theoretical models, if you're using them, would calculate a theoretical for a call option that is below its intrinsic value, and it's that at that time, it is those circumstances when the early exercise of a call is in the best interest of a holder. And of course, the American style pricing models can incorporate that early exercise feature for dividends. Of course, I'd be remiss if I didn't discuss puts at least a little bit. In-the-money puts, deep in-the-money puts are also subject to early exercise. In this case, what I would do is think about what's the benefit to the option holder, the put holder, to exercise early. If they do so, they're delivering shares and they're receiving cash. Their cash balance will increase by the amount of their strike price. If the cost of carry, or in other words, the amount of risk-free interest that they can make on that dollar amount is greater than the time value of the option, then again, it's an early exercise candidate. And similar to the theoretical explanation with the calls, models can actually price in interest rates and time value and make a comparison there. You could get a put option that has a theoretical value using the pricing models that is below its intrinsic value, and in those instances, that is when early exercise would be in the best interest of the option holder. If you followed that, you would also maybe start to tie together the reason why you might see a European option or an index option trade below its intrinsic value, because that's what it's worth. For a call option, you cannot exercise early. If there is an index that pays dividends and its underlying value is going to decrease in the future, then the intrinsic value is going to be greater than its theoretical, and it'll trade that way. Same thing for puts, for deep in the money puts. If you can't exercise early and make that level of interest, then you're not even willing to pay its intrinsic value. So you'll see put options trade below its intrinsic value on occasion in those European options. So early exercise certainly important for calls and puts. There was a lot there, so I hope our listeners absorbed as much as they could. The last topic, and we're certainly going to get to some questions. And
not to cut you off,
yes.
But I think what you said is really important, because it also kind of plays into the idea of our rates, right? Like as far as rates, what we have, as far as what's going on with the market and with the Fed and rates, how they're they're talking about potential cuts, but where we are right now, we're higher rate-wise than we were, a year ago or so. And I know when I came into the business, rates were much higher. And so that is a situation that kind of can eventually affect that, if I'm correct, right? Like the idea of whether you have to would look to exercise those puts and things like that. So,
yeah, the movement of rates, I'm glad you said that. The movement of rates is often ignored because they don't happen too often. Of course, everyone knows what the risk-free rate is. It's not an unknown, so it doesn't get too much attention. But you're exactly right. As they do move, and they have over the years, that does change the outlook. It'll change forward values, and it will change the cost of carry calculation, and theoretical models will give you different options values if you change the interest rate, and that could change the decision-making process. So as we move forward this year and into next, who knows what's going to happen with interest rates, but if they change, that could change the scope of analysis for option holders and option writers. The last thing I want to talk about is pin risk. Selling options is the theme. Pin risk is going to be something that investors should be aware of and keep their eye open for. So let's just start at the top. For anybody out there who may have not heard the term before, Jamal, how would you define pin risk? And then what are your thoughts as far as keeping your eyes open for pin risk, and what's a good time or how to manage against the risk that it involves?
So it's so funny. I'm sure you remember your first couple of expirations. I know I certainly remember mine. And so this idea of pin risk, it pertains to expiration of options. So as the options expire, if, I'm sure some of you have probably dealt with this already. There's just the idea of expiring options, right? And sometimes it's just they're way out of the money and you don't even have to think about it and you move on. And expiration comes and goes. However, there's a lot of you that either have already dealt with or have yet to deal with this idea of pin risk, which is the idea of, say you have let's talk about XYZ stock trading 50 at expiration Friday, and market opens and you have let's say you're long the 50 call option. Let's make it simpler for the time being. You're long a 50 call option, and in the morning, say that option, starts out and it's worth 40 cents. But as the day goes on, the market is kind of trending up and then maybe trending, starting to crater down a little bit. And so you're not really sure where this stock is going to close on Friday after the close. And that is in essence pin risk, because where the idea comes from is that your option may pin right there at the strike, meaning it may close at 50 and then your option basically that you were long is going to expire worthless. And sometimes those of us are kicking ourselves like, oh man, I wish I would have sold this out, for maybe 30 cents early in the day, and now it's only worth 2 cents with 10 minutes to go until the close. And a lot of the times what will happen is that, say it's worth 2 cents, but the market will be no bid, literally like zero, so no bid at, say 3 cents or something, which is really 1.5, but say it's no bid at 3 cents, and you really can't sell it out, and there's really not much you can do, so you're just left there holding the bag. And that's kind of pin risk. That's it right there. And so those are the situations where, say the stock does close at 50.01, that gets back to what Ed said earlier, you have automatic exercise for an option that's a penny in the money, and if you didn't want to exercise that option, you would have to notify your brokerage. Otherwise, they're going to exercise that option for you. So that's a small example of it. Another example of it is if you're short the option. Well, then you really got a pickle, because now you're short that 50 call, and if it winds up in the money, you'll have the obligation to sell shares, right? So you don't have any control over it. And so that's what we're talking about when we're referring to pin risk, because it's an interesting situation in that you have so much uncertainty and your option is pinning right there at the strike. And if you're long it, you have to make a decision whether you would sell out at some point early in the day. And again, there are people who do. It's easy to play Monday morning quarterback and say, well, I'll sell that out for 30 cents. And then for whatever reason, the market turns and goes up, and that option ends up being worth $1.50 somehow, right? It goes $1.50 in the money. That happens as well. So it's just this crazy situation that can happen. And, there's a couple of different things to do. These are definitely not recommendations, but these are what you want to do. It's just like anything else in life. You want to lessen your anxiety. And so if possible, say you're long an option, you can, if you still really feel a certain way about the stock and the options that you have, you could look to close that out, or you could look to roll that option to the next month. It just really all depends up to you. There's just a lot going on typically around expiration, and if you have multiple positions that are expiring, you definitely want to lessen up your risk by looking to close out your options or just roll them to the next month. And then that's one less thing you have to worry about, because again, there's a lot on the line in those situations, because you're either going to have to determine whether you want to if you're long it, whether you want to take on a stock position, or if you're short it, the option, then you have the obligation that you're going to be that's going to be put upon you. So it's a very precarious situation to be in, but you can go about ways of trying to lighten your load, so to speak, and that you don't have to worry about this as much. And trying to do that ahead of time is probably the best way to do it.
Well, Jamal, I certainly remember my first expirations. You hit the nail on the head there for sure. And I remember throughout my career, whether starting on the trading floor and then going electronic, at the opening bell on expiration day, I was looking at all of the strike prices that were near at the money and seeing where this risk was, which strikes was I long, which strikes was I short. And there was a fairly wide range of strikes that I wanted to simply just close out that day. That was my objective. If I was long, I wanted to sell, and if I was short, I wanted to buy, and I wanted to flatten those strikes. As the trading day went on, of course, you're approaching the closing bell. The range of strikes I was concerned about started to shrink. But the idea was exactly as you had suggested, that by the time you got to the end of the trading day, you didn't have a position one way or the other, whether it be long or short, and you weren't stuck with this uncertainty of where exactly is this stock going to close, and then what does that mean for exercise and assignment. It goes both ways, whether you're long or short. You don't want to be long options and have the stock sit right there at your strike price, but also for shorts, and maybe a little more emphasized on the short side, because if you're stuck in that position, you don't know. At least when you're long options, you can control whether or not you exercise and what you want to do with that. But when you're short, you don't know how many options are going to be assigned when the stock is really close. So the only way to avoid that is to buy back your options or close them out and not have an assignable position. Whether or not you decide to do that is up to you. Some investors may want to ride the whole thing out, and if they get assigned, they'll manage it from there. And they even if the option, and I've talked to many investors say, well, even if it's trading for a nickel or a dime, I want to just ride the whole thing out to zero. And if I'm assigned, I'm comfortable with that. And that's a perfectly feasible approach. Others will say, look, if it's only trading for a few pennies, I'm buying the thing back and I'm getting out. Either way, it would be up to the investor to decide for themselves. So that covers pin risk really well. In the beginning of the presentation,
one thing I think bears mentioning is the fact that, again, we're talking about pin risk with regard to American options, and I think something that everybody should be aware of is that with regard to index options, it's a little bit different, because index options settle European style, they cash settle. They are European style options in that you can only exercise or get assigned at expiration. Of course, you can sell and you can buy and sell the option anytime during the lifetime of the option, but at expiration, they cash settle. They don't settle into shares. So the index options that I'm kind of referring to, some people may be familiar with the SPX options, the Russell 2000 options, the RUT, or maybe the NDX, the NASDAQ options, and even VIX, which is definitely something that is a little more esoteric to some people. But just this understanding of index options settle in the cash. And that's a situation where you don't have to think about delivery in shares, because it settles to the cash value of your option. So I think that's something for those to be aware of if they are thinking or maybe already trading index options or at some point looking to do that.
Yeah, that's a great point. Being cash settled certainly takes the uncertainty of a position the next day out of the picture. You don't have to worry about that. You're going to cash settle one way or the other, and certainly pin risk is really focused on a physically settled product and what your share position might be on the day following expiration. So good point there. We did have a few questions, and you had mentioned covered calls and cash secured puts earlier, so I want to ask you a few questions there. But I'll take this one first. This question's about buying protective puts. We're really focused on the selling side, but I'll take it real quick. The question is, please make the case for buying protective puts. If you're bearish, you shouldn't just take money off the table. I presume taking money off the table means you're just scaling down. It's a debate that many traders get into for sure. If you are concerned about the downside, you do have a couple of choices. You can either scale down and increase your cash position and lower your exposure, or you can buy protective puts. Protective puts offer some advantages there. Of course, the disadvantage is they cost something when you scale down or take money off and reduce your exposure. You're not paying anything. If you buy a protected put, you have to pay something, and that's a cost, so that's a negative. But on the plus side, you now have protection in place that can protect you overnight. It can protect you over the weekend. You don't have to be concerned about waking up Monday morning to a huge market drop. Also, you can stay in the trade. If the market drops dramatically, you know your protection is in place. You know where the strike price is, and you can feel comfortable sleeping at night knowing that you have the right to sell out of your position. If the market happens to rebound and come back up higher, that put is still in place. It doesn't go away. So that works a little more comfortably than either scaling down or using a stop order. That's another choice you can use. Use a stop order to get out of a position. The long put will allow you to keep in the trade and not get you out as soon as the market drops down there. So there's just a few thoughts about that. Now I want to come back to the few strategies you had mentioned earlier. We've got about 5 minutes to go. You mentioned covered calls and cash secured puts. One question about covered calls, very common, is do you have a preferred approach when it comes to selecting strike and expiration? We got into this a little bit about expiration with our Theta discussion, but if someone's got a long stock position, they want to sell a call, how do you go about fine-tuning the strike price and the expiration date?
And again, that kind of gets into, as far as going with the expiration date, like we said, it really depends on the how comfortable you are as far as trading. When you're initiating your position, how comfortable you are with the different time frames. So as we said, obviously, the Theta is going to more rapidly decay as you are closer to expiration. So if you have like an option that's 1 month out. However, you should also be aware that when you're looking to trade that covered call, I guess starting with the strike first. So I would look at an area. If I'm long my stock, I would look to sell a call at a strike price that I feel comfortable, that if I'm assigned on that call, that I'm comfortable selling stock. So I think that's the number one thing. And once you do that, everything else kind of falls into place, because again, you have to, if you say, oh, okay, I want to sell 1 month out call, and I want to do it, at a call strike that's maybe 25% away from at the money. Well, the premium for 1 month out is not going to be the same. That premium, that 25% up call is always, for 1 month out, is always going to be less than, say, 3 months out. So that's the number one thing to know. It also gets back to the amount of premium that you want to sell, right? So again, but if you have it to the point where you're saying I'm 25% up from where I am right now, I would be comfortable selling stock there, then that's your personal decision, and that makes sense to some degree, because you're saying, if this is an area where I would be comfortable selling stock anyway. So if this happens and I get a sign here, fantastic. So I think, that kind of goes hand in hand, determining where you would love to just, the amount of premium you'd like to take in, and how far out you want to go. In some cases, some people do shorter time periods. They say 1 month. Some people say, well, 3 months out is where I typically like to have that. I like to give it some time to sort of take place. And it also depends on the stock too, the volatility of the stock. Is it a volatile stock? Could it move 25% in a day, or does it just move 3%, on the regular? So understanding that kind of thing, that goes hand in hand. Understanding how far up you'd be comfortable selling stock, and knowing that, again, like we just talked about earlier, the way Theta affects your option and how far out you want to be, or not as far out. And we're just talking about the covered call, right? I think that was it. We weren't talking about selling.
Yeah,
okay.
Yeah, and you covered the answer really well. No pun intended. You did really well with that, so I got nothing to add. I'm going to ask just one more question in the minute or so we have left, and while I do that, I'm going to throw up our contact information for our audience to visit the website, check out our YouTube. Please remember to fill out the survey as you leave, and email the investor services team with your questions. Last question of the day, Jamal, is about sort of earnings and vol. We talked about that earlier. Question, it's a bit direct. What's the best way to play earnings that are 2 weeks away? I noticed the option prices went up a lot more than usual for the week of earnings. I presume that means that volatility creeped up prior to the earnings announcement. Does that mean volatility is priced in already? Do you have any thoughts on that as far as playing earnings are a few weeks out Do you expect to see vol creep up into that? Is vol priced in already, and should it remain fairly constant until the announcement? Do you have any insights on what you might expect to see there, or is it a little bit of all the above?
Yeah, it's always interesting in that the way the market handles our volatility. I mean, our markets are very efficient, and we're at a point now where it's hard to know more than what the volatility of the options in the market is already showing you. So we do know that volatility does creep up as it goes into earnings. With 2 weeks away, depending on the stock, of course, depending on the volatility of that stock, inherently, it's probably going to go up a little bit more, but you just really, it's hard to sort of play that. The best way, it's hard to say there's a best way, but it really depends on what your sentiment around the stock and the options are. I mean, you do have to be aware that, if you are buying options if you're buying these options, there is going to be a volatility crush post earnings, and so you have to sort of be aware of that and account for that. That's separate from the potential stock move that it may have on earnings as well. So it's hard to say, is there, what's the best way to play it? It just really, earnings are this real binary event that there's so much uncertainty around. And typically what people will try to do to account for that uncertainty is try to add some numbers to it, right? We're in the age of analytics. And so a lot of people will go back. Sometimes you have services that provide you the last, say, a year or 2 years of data of earnings, how much it's moved typically, how much the options are pricing in typically, right? And so this kind of gets to a high-level conversation, but it's difficult to determine the correct way to play any earnings. I mean, nobody really knows. That's why they're so awesome in that way. I mean, they're big winners and they're big losers based on how you play, and there's so many different ways to play it. So I think it's just important to understand that the volatility will creep up each day as you go into earnings, and it will, the ultimate high will be right before the earnings announcement, whether it's that night before or the day of. And so you sort of have to kind of make a determination ahead of time whether you want to play a directional thing or you want to be direction agnostic, but you just want it to move. If you're long a straddle or something like that, or if you just feel the volatility is going to come in so much that it's prudent to sell options. It just really depends. But however you do it, be careful in understanding that earnings is such a binary event that whatever position you could possibly lose in multiple different ways. So understand those components of earnings, whether it's a stock move and the volatility move, and know that those are going to affect you.
Yeah, difficult is right when you're trying to interpret what exactly implied volatility is telling you when you're looking at a number, and if things are priced in already or not, and where it might be moving prior to earnings. That's a challenging task, and all traders, all investors have that challenge in front of them. And if you do want to move vols around a little bit, as I mentioned before, a pricing calculator, an options pricing calculator can let you do that, change vols and see what's going to happen to the option price, and then maybe you won't be as surprised as it moves. That's what makes implied vol so important. So thanks for your attendance today, and we'll see you next time.